Toyota, Honda, and Nissan officially reach agreement with Southeast Asia and announce withdrawal schedule from China. Xi Jinping in panic announces tax cuts for Japanese cars. Japanese government calls for rejection of China and unveils massive relief package. Everyone shocked by the damage to China's economy. No Japanese companies remain in China. According to Professor Takahashi Yoichi, the strategic exit of Toyota, Honda, and Nissan from China marks a significant shift in global supply chains. The decision by these major Japanese automakers to shift their production to Southeast Asia, including Vietnam and Indonesia, reflects a calculated move to reduce dependency on China. These corporations recognize that, despite China's large market, escalating production costs and political risks make the country less favorable. Japan's implementation of the China Plus One strategy was initially motivated by the need to diversify supply chains after the COVID-19 pandemic highlighted vulnerabilities. The pandemic's disruption of global trade exposed how concentrated production in China could lead to severe economic disruptions. Japanese companies, which had heavily invested in China for decades, started reassessing their reliance on the Chinese market. Toyota and Honda, for instance, faced increasing costs from higher labor rates and tougher environmental regulations in China, which undermined profitability. The decision to relocate, as pointed out, was also driven by the emerging manufacturing hubs in Southeast Asia. Countries like Vietnam and Indonesia have actively offered investment incentives, lower labor costs, and political stability, making them attractive destinations. These nations have built solid trade relationships with Japan, creating a framework where Japanese companies could seamlessly integrate their supply chains. The free trade agreements (FTAs) between Japan and ASEAN countries further eased the movement of production, ensuring that the transition was efficient. For China, the loss of these manufacturing giants signifies a broader economic and geopolitical concern. The Japanese company's withdrawal not only deprives China of significant foreign direct investment (FDI) but also damages its position as the world's factory. Takahashi noted that as these automakers exit, the local suppliers and workers who rely on them face uncertain futures. This disruption extends beyond immediate job losses, potentially creating a ripple effect in China's industrial hubs like Guangdong and Shanghai, where Toyota and Honda operated significant facilities. Takahashi's analysis emphasizes that while China attempted to mitigate the damage by offering tax reductions and incentives to Japanese automakers, these measures came too late. The entrenched political and economic risks, coupled with rising production costs, made it impossible for these companies to justify staying in China. Additionally, Beijing's increasingly aggressive stance on geopolitical matters, particularly regarding Taiwan, only exacerbated fears that the region could face further instability, deterring foreign businesses. According to Yoichi, Chinese leader Xi Jinping was thrown into panic mode as major Japanese automakers like Toyota, Honda, and Nissan began their exit from the Chinese market. In response to the departure, Xi quickly announced a series of tax cuts aimed at retaining Japanese companies in the auto industry. These cuts specifically targeted the production of electric and hybrid vehicles, sectors where Toyota and Nissan had significant investments. However, despite the incentives, Takahashi argued that the damage had already been done, as the company's decision to relocate was driven by deeper economic concerns. Professor noted that China's aggressive geopolitical posturing, particularly in the South China Sea and Taiwan Strait, played a significant role in the departure. Japanese automakers no longer viewed China as a stable environment for long-term investments, particularly given the uncertainties of potential conflict. In addition, rising labor costs, stricter environmental regulations, and supply chain risks only exacerbated the situation. Thus, even with tax reductions, the automakers saw more secure opportunities in Southeast Asia, where governments were offering generous incentives, lower costs, and political stability. Xi's frantic decision to lower taxes for Japanese car companies was a desperate attempt to reverse the damage. Still, it did little to convince the automakers to change course. Being emphasized that, in hindsight, China's reliance on foreign investments from Japanese firms had backfired, as it had failed to diversify its industrial strategy. The departure of such key players highlighted the vulnerabilities within China's economic model, especially in sectors where it struggled to compete with other regional powers like Vietnam and Indonesia. The Japanese government's response to the increasing tension with China was both swift and decisive. Faced with the exodus of major Japanese companies like Toyota, Honda, and Nissan from China, Japan's government took the bold step of calling for a collective disengagement from the Chinese market. This action was paired with a massive financial stimulus package, valued at approximately $2 billion, aimed at assisting Japanese firms in relocating their production facilities. The goal of this initiative was not only to ensure the stability of Japanese supply chains but also to reinforce Japan's long-term security strategy by reducing dependency on China. In some analysis highlights that the Japanese government viewed this departure from China as a necessary move in the context of global economic shifts. The exit wasn't solely about short-term financial gains. It was driven by broader geopolitical factors, such as China's increasing assertiveness in regional disputes and ongoing trade frictions. By incentivizing companies to relocate, Japan was signaling a more robust stance against China's growing influence, particularly in the economic and industrial sectors. The financial package was part of Japan's larger strategic plan to protect its national interests. It included subsidies for companies that chose to relocate their manufacturing operations to Southeast Asia, such as Vietnam, Indonesia, and Thailand, as well as significant support for businesses returning production to Japan itself. By providing these incentives, Japan ensured that its industrial base would not be disrupted, even as companies disengaged from China. For China, this move represented a severe blow. The loss of major foreign investment, particularly from critical industries like automotive manufacturing, exposed the vulnerabilities in China's economy. Takahashi emphasized that despite China's efforts to keep these companies through tax incentives and other measures, the broader strategic decisions of the Japanese government, driven by a combination of economic pragmatism and geopolitical foresight, prevailed. This withdrawal not only signaled Japan's rejection of reliance on Chinese manufacturing but also underscored the shifting dynamics of international trade and production in the face of escalating global tensions. The economic impact of Japan's withdrawal from China shocked many observers. The sudden loss of investment and production by major Japanese companies exposed China's deep vulnerabilities. For decades, China had been a central hub for global manufacturing, but the departure of key players like Toyota, Honda, and Nissan left significant gaps in the country's industrial landscape. According to some experts explained that while China tried to mask the severity of the situation through tax incentives and other policy adjustments, the damage was undeniable. The loss of foreign direct investment (FDI) from Japan dealt a heavy blow to China's automotive and manufacturing sectors. Factories that once thrived in regions like Guangdong and Shanghai faced closures, and local suppliers, reliant on these Japanese giants, struggled to stay afloat. Takahashi emphasized that the departure not only resulted in job losses but also crippled related industries dependent on automotive exports. China's attempts to attract new foreign investment could not keep pace with the speed at which these major firms exited, leaving a void that was difficult to fill. Furthermore, the broader economic effects rippled through China's financial markets. Investors, witnessing the exodus of critical players, grew wary of China's long-term prospects. Stock markets in Shanghai and Shenzhen reacted sharply, with significant declines in sectors linked to industrial production and exports. The withdrawal highlighted the fragile state of China's economy, which was already grappling with slowing growth and internal challenges. Concluded that this shock served as a wake-up call for China, revealing how dependent it had become on external investments and how much it stood to lose in a shifting global landscape. By the time 2024 came to an end, the landscape of Japanese industry in China had drastically changed. Major firms like Toyota, Honda, and Nissan had fully withdrawn their operations, leaving behind an economic vacuum that China struggled to fill. The once strong presence of Japanese companies in key industrial zones had vanished, marking a historic shift. Some articles highlighted that China, despite its efforts to retain these corporations through tax incentives, could not halt their exit. For China, this meant losing a reliable source of foreign investment, technology, and innovation. The factories that once employed thousands were either closed or repurposed, leaving local economies in disarray. This absence was a clear signal to the global market. China was no longer seen as the dominant destination for Japanese manufacturing. The exit of Japanese companies symbolized more than just an industrial shift. It marked a fundamental change in global supply chain dynamics. Being emphasized that this exodus was driven not only by economic considerations but by a re-evaluation of geopolitical risks. China's increasingly assertive foreign policy, coupled with rising production costs, had made it an untenable environment for long-term investments. The decision of these corporations to relocate production to Southeast Asia or back to Japan underscored a broader trend of decoupling, particularly from China's industrial dependence. Ultimately, noted that the complete absence of Japanese companies in China was a symbolic turning point in the two nations' economic relationship. Japan, once heavily reliant on China for its industrial growth, had chosen a new path, distancing itself from the risks associated with China's evolving political landscape. For China, this marked the end of an era, with profound economic implications that would resonate far beyond its borders.